Hello, today we're going to be talking about internal succession planning and how to prevent taxes from killing your succession plan. And by succession plan, we mean a transfer of your company to key employees or family members. And now there's a couple basic truths that we need to get to right before we get into this. Number one, your buyers don't have any money. You know how much they make, you pay their salaries, right? These people do not have any money. That's the first challenge. Number two, the buyout is all about cash flow, the predictable recurring cash flow of your business. And so it needs to be predictable for there to be a sustainable process to transfer the business. And most importantly, number three is that it's going to get taxed twice. So we're going to walk through a quick example about how taxes might kill your internal transfer. And then we're going to talk about a couple remedies or ways that you can mitigate some of the tax damage that gets done along the process. So let's assume you're in California and you have an S corporation, which is what we call a pass-through organization, meaning the money that you make as the business owner flows right down to you as the business owner, and you get taxed on that whether or not you take that into income. And so what happens is, if you were to sell your company to a key employee, that money is then going to start flowing to them just like it did to you, and they're going to pay tax probably at the highest ordinary income bracket, which federally is 39.6%. In California, that would be 13.3% of state tax on top of that. So that $1 that your business made just got taxed at 53%. And so that employee now only gets 47 cents on each dollar to turn around and pay you to buy out the company. Well, unfortunately, you still have to pay tax too. So on top of the ordinary income tax, you as the business owner are also going to pay capital gains on everything above your basis. Ask your accountant if you want to talk about basis, what that is and how that works. But trust me on this, there are two levels of tax. The good news is there are a couple easy ways to mitigate some of this tax, and that could save you tens or hundreds of thousands of dollars. Three quick ways to mitigate taxes. Number one, Section 2704. That's an internal revenue code that allows for you to shrink the value of the stock for lack of marketability and lack of control. You should talk with your CPA and attorney about this, but we can take that stock value that you would otherwise sell for and shrink it down if you're transferring a minority interest or an interest in a company that, like yours, is closely held and therefore can get discounts to that value. That's a great start, but then the question is, don't I receive less for my business? And the answer is yes, but that leads to the second point, which is to make up some of those payments through direct compensation, meaning you can stay on as a consultant, you can put in place a deferred compensation arrangement, or there are other mechanisms to get you cash that is going to be deductible at the company level. And then the third option that's really important to consider if you're transitioning, especially to family, is gifting. And gifting allows you to take some of that stock value that's subject to that double taxation and get it to the next generation via a gift that needs to be properly accounted for and valued, and that reduces the amount that goes through that double tax. And again, you can get direct payments out to you as an owner through deferred compensation or other mechanisms. So those three things alone could save you a couple $100,000 in taxes depending on the size of your business.